morning, everybody, and firstly I'd just like to say thank you to the ASX for inviting us to be a part of today's Meet the Manager Forum. We do appreciate it, and it's great to be here. Now, before I actually commence the discussion on emerging markets, just thought I'd give you a little bit of background on Fidelity. So Fidelity was established by the Johnson family in Boston in 1946, so we have 72 years of investment heritage, and it's a privately owned investment company. So it's actually led now by the granddaughter of the founder, Ned Johnson, who established us in 1946, but now led by Abigail Johnson. In Australian dollars, we have about $3.5 trillion in assets under management collectively across the world, so it is very much a large business. And our belief is that markets are very much semi-efficient, and by that I mean that market information's less than perfect, and in our view, if you apply fairly comprehensive, intensive, rigorous bottom-up company research, then you should be pretty well placed to outperform markets over the medium to longer term. This morning I'll cover off four key areas quite promptly. We'll look at emerging markets at a glance. We'll cover a couple of key structural themes that we're seeing in emerging markets that will play out over the next few decades. We'll talk about how we manage investing into emerging markets, and then a very brief outlook on what we expect to see, what we're seeing at the moment, and also what we expect to see as we move forward. When you look at emerging markets in terms of the index, the MSCI, or the Morgan Stanley Capital International Index, was established in early 1988, so it's been running and operating for about just over 30 years, and there are 24 countries that are represented across this index. So you've got 5 in the Americas, you've got 9 in Asia, and you've got 10 across mainly Europe, but also Middle East and Africa. And the common theme that really binds these countries together is that they are developing markets, and there are also a number of demographic traits that are very much characteristic of these markets as well. There's also 845 companies represented across the index, and as much as sentiment tends to drive both positive and negative returns over the short term, when you actually look out over the longer term, whether it be countries or companies that you're looking at, it's more those idiosyncratic attributes that tend to play out as you invest. It's also worth noting that as of tomorrow, there'll be 236 large-cap Chinese A-shares being added to this index as well. So that'll bump up China's allocation by about 0.5% from tomorrow. So that's the first time Chinese A-shares have been added to the index, so a fairly momentous occasion. And essentially, Chinese A-shares are ultimately they're priced in local currency renminbi and traded on the Shenzhen and Shanghai exchanges. When you look at the market capitalisation, as I said, keeping in mind that the index is about 30 years old, from fairly humble beginnings in 1988, when the index was market capitalisation of about $59 billion, it now is worth in Australian dollars just over $7 trillion across the market cap of those 845 companies. And it's interesting when you look back all the turmoil that we've seen over the last 30 years, despite all sorts of ups and downs, crises in developed markets and emerging markets, you've had pretty good, strong growth across that world over that particular time. And what we're finding as well is that emerging market companies are starting to creep into our lives by way of a whole range of goods and services more than ever as well. So whether it's Hyundai cars, or it's Lenovo laptops, it might be an LG TV, or even Taiwan Semiconductor that make microchips for your Apple phones, are good examples of companies that are represented across the emerging markets. To give you an idea of performance of emerging markets, so this just takes it back to the end of 2000, and what it essentially highlights that is, if you'd had $10,000 and you had reinvested all your distributions or dividends back into the respective indexes, this is the way that they would have performed. So the MSCI Emerging Markets Index grew from $10,000 to just under $39,000. And the Morgan Stanley Capital International All Countries World Index, which is essentially measuring the value of the world's stock market, just over $18,000 over that particular period of time. Key thing to realise is that the emerging markets component of the world index is only 10%, so it's still fairly small in the broader scheme of things, and as you can see, it's also fairly volatile as well with regards to variability of returns. And the way that we look to mitigate that volatility and manage that volatility is to apply a fairly comprehensive approach to active portfolio management with a strong focus on corporate governance and balance sheets as well. This gives you an idea of the volatility that's also been characteristic of the emerging markets index relative to the world index in an absolute and relative sense. You can see that it's certainly been a roller coaster ride over that time. But ultimately, as I said, one of the key things that we look to do, you can't control volatility, you can be aware of it, you can manage around it, is to ensure that ultimately, whether it's as I said, representative of those 845 companies in the index, we look to own roughly 35 to 40 that we believe are the best medium to long-term ideas across the market. And the other thing to be aware of, volatility can also present opportunity. It's certainly uncomfortable, particularly when you've got the price of stocks going south at a rate of knots. But when we look out to investing, we're looking out sort of 3 to 5 years plus. Sometimes that can present opportunities to buy companies that we really like that are good value. The second point I'd like to raise is just when you look at the structural themes happening across the emerging markets as well. So the rising importance of emerging markets, when you look at the contribution of emerging markets to world growth or GDP, you go back to the 80s and 90s, economic output from the emerging markets was around a bit over a third. We now find ourselves in a situation where economic activity across the emerging markets is 60% of world activity, and developed market is 40%. We only see that growing over time as well. When you look at incremental GDP, the sort of growth you're seeing year on year, economic incremental GDP growth in the emerging markets is 80%. So once again, all those emerging markets and frontier markets across the world are growing quite substantially as well. And the one thing, as much as that's a great long-term structural story, you do need to be conscious of the fact that you will get cyclical factors that create volatility in the short to medium term as well. And on the topic of young populations, this highlights that point particularly well. You can see here in the emerging markets, Africa, Asia, Latin America, you really do have young populations, growing populations, and the other factor that's very much characteristic of these economies relative to developed markets, you're seeing reasonably good incremental income growth in those countries as well. So once you sort of get past the basics and you start to have a bit more discretionary income, you're able to buy a whole range of goods and services that we all tend to take for granted. And that's happening quite substantially across these markets as well. When you look at GDP per capita, or essentially GDP per person in these markets as well, it's quite a fascinating story. The blue bar essentially represents the level of income in US dollars, essentially on a GDP per capita basis back to 2014. And then you can see what it's budgeted out to look like in 2050. And the key point I take from this really is the fact that if you look at where Australia's income levels are now, sort of 50,000 US roughly, there'll be a whole range of emerging market countries that will not only reach those levels of income in 30 years' time, but will also in some cases exceed it. So income growth is going to be quite substantial. And a very quick, simple example to characterise this, when you look at the topic of beer, for example, right? So if you're in a country where GDP per capita is around $5,000 a year, beer consumption's around 6 litres per annum, so half a litre a month, which probably wouldn't get too many people in Australia too far on a Friday night. When you go to $10,000 of income per annum, beer consumption goes from 6 litres at 5,000 to 60 litres. So once again, discretionary income really cutting to play out there. So I suppose the tip is double your income and you get to drink 10 times as much beer. In terms of Fidelity, the way we approach emerging markets, the key thing to realise with us is that we take very much, with the Global Emerging Fund, it's a very much a high conviction, concentrated, benchmark unaware approach. So typically there are 35 to 40 companies that we'll own out of those 845 companies in the index, and it's led by Alex Duffy, who's our Singapore-based Global Emerging Markets Portfolio Manager. And he is supported by 53 analysts in the emerging markets across the globe, 143 globally, and collectively across Fidelity we do about 15 to 16,000 company meetings every year. So it's a comprehensive, never-ending process of analysis. Key things that Alex looks for really is we only invest in companies we understand. That sounds pretty straightforward, of course, but ultimately what we're looking to do there is to ensure that you have a very clear, articulate understanding of corporate governance. So Alex's view is that when you look at where things tend to go wrong in emerging markets companies, corporate governance is often a key culprit. So we pay enormous amounts of attention to corporate governance, understanding who we're investing with, understanding the backgrounds of investors and directors, I should say, as well as the company management team that run these businesses. So ultimately we direct about 95% of the index to own just under 5% of the companies represented across the emerging markets. The other key thing is balance sheet. So once again, we want to own companies that have got long, good standing and durable balance sheets that are able to invest through the cycle, but also are strong enough to withstand more challenging periods through the cycle as well. And ultimately, we're also looking for companies that have the ability to reinvest back into their business at higher marginal rates of return. So typically, when you look out 3 to 5 years, you're looking for companies that are going to grow sensibly and progressively through those periods. But ultimately for us, obviously valuations are critical, but certainly corporate governance and balance sheet strength are really the two key things that we look for specifically across the board. A simple example, AIA Group, I won't go into this in great detail, but other than to say it's our largest holding in our Global Emerging Markets Fund at the moment. If you look back to some of those themes I mentioned earlier regarding growth in emerging markets, wealth and income, a company like AIA is potentially well suited to benefit from some of this growth that we'll see over the years. And you can see the point there, also strong balance sheet with better solvency. So that theme coming through once again. And for a company like, whether it's AIA or any others that we own and a whole range of companies that we don't own, then we look at every company, at least every 3 to 4 months, we look at who their competition is, who their customers are. We look at speaking to regulators just to ensure that we have a full 360-degree view of those companies. And ultimately, when you're investing in this part of the world, it's patience, it's prudence are the things that are most critical to apply. That just gives you a brief snapshot of the strategy that we operate and make available in Australia. It's been operating for 4.5 years in Australia. We've been investing into emerging markets for many decades, of course. But to explain what the graph means, the dark blue bar is really the performance of the fund after fees. The light blue bar is the performance of the index. And the light brown bar essentially represents the outperformance of the fund relative to the index. So ultimately, it's been a fairly good, steady story so far. We're fortunate that pretty much all of our strategies, whether it be out to 3, 5, or in some cases 20 years, have all been fairly strong performers over their respective tenures. And just briefly, in terms of outlook, obviously there's a bit of talk at the moment around emerging markets, particularly with what we're seeing Turkey, Indonesia and Argentina to some degree. But ultimately, our job is to find those 35 to 40 companies in all market cycles. As I said, sometimes volatility creates opportunity. Exchange rates, once again, can be a big factor in US market for emerging markets when the US dollar is appreciating substantially. But ultimately, we look at both factors there fairly closely as well. Commodities, once again, are a big earner in emerging markets as well. So we're constantly assessing what sort of impact that can have at a broader level. But generally, they've been quite strong. And the big factor that's been quite a positive for emerging markets is the developed markets of the world. The heavy lifters of the world stock market as well have been fairly strong. Even Japan's had fairly decent growth and Europe's emerged with fairly moderate growth, though quiddly might be a potential issue over there as well. Risks, balance sheet vulnerability in China. There's always concern around China. We have a whole range of people on the ground that assess the Chinese market and Chinese companies, and we're always on the lookout certainly for our process here around balance sheet risk. The political environment, we all know that every day you can pick up and there's a different thing going on, whether it's North Korea, South Korea or in the United States, so you can't always anticipate that, of course. And also persistent risk around, obviously, commodities and currencies can be quite volatile, which is why we take that longer-term prudent approach to investing to ensure that these factors don't drive our long-term decisions. It's good quality companies that tend to. The other thing I was just going to mention as well, all our funds, including this, are available via the M-Fund range, and this will also, the Global Emerging Markets Fund will also be the first one we launch as our active ETF later this year as well, with others to follow. So that's not too far away as we get to June tomorrow. So thank you for your time, and I'll be around later if anyone has any further questions as well.